You're being influenced right now, not by me, but by something you can't see, something that touches every single choice you make, from the clothes you wear to the dreams you chase. It's quiet, pervasive, and yet it determines the very rhythm of your life. It's money, not just as a thing you hold, but as a living, breathing system, and its secrets are about to be unveiled.
Money. It feels like the most tangible thing in our lives, a constant companion from our first piggy bank to our last pension plan. We work for it, we save it, we spend it. It promises security, freedom, comfort. But what if the very thing we rely on most is also the least understood? What if the familiar currency in our hands is just the visible surface of an ocean of invisible forces? This isn't a guide to getting rich or a lecture on economics. This is an invitation to look deeper, to feel the quiet hum of a system that orchestrates our choices, shapes our desires, and often, without us even realizing it, guides the very paths we walk. We will journey through the hidden architecture of the financial world, the world of debt, banking, and the intricate mechanisms that govern it all. We will explore how money is born, how it flows, and how it binds us in ways we rarely perceive. We will pull back the curtain on the quiet agreements and unspoken rules that shape our financial landscape, revealing why understanding these secrets is not just for economists, but for anyone who wants to navigate their own life with greater clarity and freedom. Prepare to see the familiar currency of your daily life not as a simple exchange, but as a language, a force, a profound influence that shapes the very fabric of our modern world. To understand this world, we must first learn how it quietly runs itself. We've seen how comfort hides control, and how design makes it irresistible. Now, let's go back to the very beginning, to a time before digital transactions and towering banks, to truly understand how this subtle design came to be. Imagine a world without money, a simpler time, when people lived in small communities. How would they trade? They would barter. A farmer exchanging wheat for a carpenter's services, a weaver trading cloth for a potter's bowl. It sounds straightforward, doesn't it? A direct exchange of value. But soon the practical difficulties would begin to surface. What if the farmer had wheat, but the carpenter didn't need wheat? He needed shoes. What if the weaver's cloth was too much for the potter's single bowl? This problem of finding a double coincidence of wants made large-scale trade slow and inefficient. It was like trying to connect puzzle pieces that never quite fit. So, humans, being ingenious creatures, found a solution. Something everyone would accept in exchange for their goods and services. Something that could be stored, divided, and carried. At first, this something might have been shells, or salt, or cattle. Things that had inherent value, or at least were widely desired. The key was trust. Everyone had to agree that this chosen item had worth beyond its immediate use. It wasn't long before precious metals, gold and silver, emerged as the favored choice. They were durable, rare, beautiful, and could be melted down and divided into smaller, standardized units. This was the dawn of commodity money, where the money itself was the value. A piece of gold was valuable because it was gold. But carrying around heavy bags of gold and silver wasn't ideal, especially for merchants traveling long distances. It was risky and cumbersome. So a new idea began to emerge, quietly, organically. People started leaving their gold with trusted individuals, often goldsmiths who had secure vaults. In return, the goldsmith would give them a receipt, a piece of paper stating how much gold they had deposited. These receipts were much lighter and safer to carry. Soon people realized they didn't always need to go back to the goldsmith to retrieve their gold for every transaction.
They could simply endorse the receipt, passing it on to someone else, who would then have a claim on the gold. These paper receipts, backed by the promise of gold, became a form of money in themselves. This was the beginning of what we call representative money, money that isn't valuable in itself, but represents something valuable held elsewhere. This simple act of storing gold and issuing receipts gave the goldsmiths a unique position. They noticed that people rarely came to withdraw all their gold at once. Most of it just sat there, unused. A clever yet risky thought might have crossed their minds. What if they could lend out some of that gold, or more accurately, issue new receipts for gold that wasn't actually in their vault, but which they fully expected would never be claimed all at once? They could charge interest on these loans, creating a profit for themselves. This was the quiet birth of fractional reserve banking, the practice of lending out more money than you actually hold in reserve. It was a subtle shift, a quiet expansion that would fundamentally alter the nature of money. But what happens when trust is stretched thin and the promise behind the paper begins to wobble? The goldsmiths became, in effect, the first bankers. They weren't just storing wealth, they were creating it, or at least expanding its apparent quantity, through the act of lending. This newfound ability to generate money from deposits, to essentially multiply the purchasing power in the economy, created a powerful engine for trade and development. Merchants could borrow capital to fund voyages, artisans could expand their workshops, and innovators could pursue new ideas. The system fueled growth, allowing societies to move beyond simple subsistence. It was like discovering that by strategically pruning a tree, you could make it bear far more fruit. This capacity to expand credit, to inject new purchasing power into the hands of those who needed it for productive purposes, was revolutionary. Over time, governments began to standardize and regulate this emerging banking system. They realized the immense power and stability that a controlled monetary system could offer. Central banks were eventually established, taking over the role of issuing currency and managing the overall supply of money. They became the ultimate goldsmiths, or rather, the ultimate promise keepers. The money we use today, the banknotes and digital numbers in our accounts, is mostly fiat money. It isn't backed by gold or silver, but by the government's decree, and more importantly, by our collective trust in that government and its economy. It's money purely by agreement, a powerful social construct. Consider the journey, from a handful of shells to shining gold, to a simple paper receipt, and finally, to pure concept. Each step moved money further away from its physical origins and closer to an abstraction, a symbol of value rather than value itself. This abstraction made the system incredibly flexible and efficient, allowing for rapid expansion of trade and global commerce. It allowed governments to manage economies, stimulating growth when needed and tempering inflation when prices rose too quickly. It was like moving from drawing with crayons to designing with complex computer software. The possibilities expanded exponentially. But with this increased complexity came a greater distance between us and the true nature of what money represents. This evolution wasn't a sudden revolution, but a slow, unfolding narrative, shaped by human ingenuity, necessity, and the ever-present desire for efficiency. Each stage built upon the last, refining the tools, expanding the reach, and subtly embedding the mechanisms of debt and credit deeper into the fabric of daily life. The system we inhabit today is the culmination of these millennia of quiet evolution, a testament to our ability to create shared fictions that become powerful realities.
It is a system designed not just for convenience, but for perpetual motion, for growth, for a subtle, constant expansion. And understanding this journey from barter to digital bytes is the first step in truly grasping the nature of the financial world that quietly runs itself and the psychology that now keeps it so powerfully in motion. We've seen how money evolved from simple exchange to a complex system built on promises and shared belief. Now, let's peel back another layer and explore the soft, subtle whispers that keep this entire delicate machinery in motion, the hidden psychology. If money is a shared story, then our minds are the storytellers and the eager listeners, constantly reinforcing its power. This isn't about logic or spreadsheets. It's about the deep-seated human emotions and instincts that are quietly tapped into, making us participate, even thrive, within the financial web. Think about the feeling of receiving a bonus at work or finding an unexpected $20 bill. There's a distinct rush, a momentary lightness, and conversely, the quiet dread that settles when a bill arrives unexpectedly or when the numbers in our account dip lower than we'd like. These aren't just practical observations, they are profound emotional responses. Money, in its modern form, has become deeply intertwined with our sense of security, status, freedom, and even self-worth. It acts as a powerful mirror, reflecting our hopes and fears, our aspirations and anxieties. This emotional connection is a vital, unseen fuel for the entire financial system. But how exactly does this mirror work its magic and keep us striving for more? One of the most powerful psychological drivers is the pursuit of security. From our earliest days, humans have sought safety from uncertainty. Money, or the promise of it, offers a modern form of this ancient comfort. A healthy savings account feels like a warm blanket against the cold winds of unexpected illness or job loss. Owning a home provides a physical anchor in a shifting world. This desire for a stable future makes us work harder, save diligently, and often borrow to acquire assets that symbolize this security. The system understands this deep need and provides pathways, mortgages, insurance, retirement plans, which, while offering genuine protection, also bind us more tightly into its mechanisms. We become willing participants, driven by an instinct older than any currency. Another powerful force is social comparison and status. Humans are inherently social creatures, always aware of our place within a group. In modern society, money and its visible manifestations, cars, homes, fashion, experiences, often serve as markers of success and belonging. We see what others have, and a quiet, almost unconscious urge to keep up or even surpass them begins to stir. This isn't necessarily a bad thing. It can motivate innovation and effort, but it also creates a constant upward pressure, a treadmill of desire. The advertising industry, a sophisticated arm of the financial world, masterfully taps into this. It doesn't just sell products, it sells lifestyles, aspirations, and the promise of a better self through acquisition. It's like a gentle current, constantly pushing us to reach for the next thing, the next upgrade, making consumption feel like progress. Then there's the allure of freedom and choice. Money, we are told, buys options. It allows us to travel, to learn, to pursue hobbies, to break free from limitations. This promise is incredibly seductive because it speaks to a core human longing for autonomy. The ability to choose, to shape our own path, is a fundamental desire. So, we strive for more money.
believing it will unlock more doors, more experiences, more control over our destiny. While money certainly can open doors, the subtle trick is that the pursuit itself often keeps us on a particular path, one that requires consistent earning and participation in the very system that promises ultimate liberation. It's a delicate dance, where the pursuit of freedom can sometimes lead to a different kind of constraint. Consider the phenomenon of debt. On the surface, debt seems like a burden, a future obligation, yet billions of people willingly enter into it. Why? Because debt often represents instant gratification and the promise of a future benefit now. A student loan means immediate education. A credit card means instant access to desired goods. A mortgage means a home today, not decades from now. Our brains are wired for immediate rewards. The future, in contrast, often feels distant and less urgent. The financial system brilliantly caters to this, making it incredibly easy to access credit. It offers the enticing taste of tomorrow's pleasures today, knowing that our psychological biases often lead us to prioritize the present moment. But what happens when the joy of instant gratification fades and the long shadow of future obligation remains? Even the act of saving and investing taps into deep psychological currents. It requires discipline, foresight, and a degree of optimism about the future. It appeals to our desire for order and control, a feeling of building something substantial over time. The slow, compounding growth of investments, while often abstract, offers a quiet satisfaction, a feeling of responsible stewardship. This patience, however, can be fragile, susceptible to fear and greed when markets fluctuate. These raw emotions, amplified by news and social media, can lead to sudden shifts, to widespread selling or impulsive buying, reminding us how deeply our collective psychological state influences the ebb and flow of global capital. The entire apparatus of money, from its creation to its circulation, is not just an economic marvel. It's a profound psychological construct. It thrives on our hopes for security, our aspirations for status, our desire for freedom, and our human tendency towards instant rewards. It creates a shared, invisible language of value that we all understand and respond to, often without even thinking. The system doesn't force us, it simply invites us to play a game whose rules are deeply aligned with the very wiring of our human nature. This intricate dance between our inner world and the outer financial one is what gives money its incredible, enduring power, gently pulling us along its currents and setting the stage for the everyday mechanisms that you might often miss. We've delved into the deep psychological currents that keep the financial system alive, recognizing how our hopes and fears are quietly woven into its fabric. Now let's bring it closer to home, to the tangible yet often unseen mechanisms that operate around us every single day. These aren't grand economic theories. They are the quiet clicks and whirs, the subtle shifts and flows that govern how money moves from one hand to another, often without our conscious attention. Understanding these everyday mechanics is like learning the hidden grammar of the financial language you speak constantly. Think about your paycheck. It arrives, a number appears in your bank account, and you use it to pay bills, buy groceries, or save for a dream. It feels utterly normal, almost automatic, but how does that money actually get into your account? It's not physical cash being moved, it's a digital instruction, a line of code moving from your employer's bank to your bank. This process relies on a vast, interconnected network of financial institutions and clearinghouses. When you pay a bill online or tap your card at a store, the same intricate dance occurs. Your bank communicates with the merchant's bank, often through intermediaries, to verify funds and transfer the digital equivalent. It's incredibly fast, incredibly efficient, and almost entirely invisible. This digital ballet is one of the most fundamental yet overlooked mechanisms of modern money. Consider the simple act of using a credit card. It feels like spending your own money, doesn't it? But it's not. When you swipe or tap, you're essentially taking a short-term loan from the bank that issued your card. The bank pays the merchant immediately, and then you owe the bank. This mechanism, repeated billions of times a day, is a core driver of credit creation. It allows for immediate gratification, as we discussed, but it also creates a constant stream of interest income for banks, fueling their growth and power. The convenience is undeniable, but it's a convenience built upon a temporary debt, a quiet promise to pay that hums beneath every purchase. And what happens when those promises become too numerous, too heavy to bear? Another crucial, often missed mechanism is the role of interest rates. We hear about them in the news, often in relation to the central bank. But what do they really mean for your daily life? An interest rate is essentially the price of borrowing money, or the reward for lending it. When you take out a loan, the interest rate determines how much extra you'll pay back. When you save, it dictates how much your money will grow. Small changes in these rates can have profound ripple effects. A slight increase can make mortgages more expensive, cooling down the housing market. A decrease can encourage businesses to borrow and expand, stimulating the economy. Interest rates are like the invisible levers that guide the flow of financial water, speeding it up or slowing it down, subtly influencing every economic decision you make, from buying a car to starting a business.
Then there's the quiet power of inflation. This isn't a mechanism of transfer, but a mechanism of change in money's value. Inflation is the gradual rise in prices for goods and services over time, meaning your money buys less than it used to. $1 today isn't the same as $1 50 years ago. This steady, almost imperceptible erosion of purchasing power is a constant feature of modern economies. It encourages spending because money held on to too long will slowly lose value. It discourages hoarding and keeps money circulating. While a little inflation can be healthy for an economy, too much can quickly unravel savings and create instability. It's like a slow, steady tide that almost imperceptibly reshapes the shoreline of your financial landscape, always pushing you to move, to invest, to spend, lest your carefully built sandcastle is slowly washed away. Even the simple existence of ATMs and online banking apps represents a complex web of mechanisms. They offer unparalleled access to your money, anytime, anywhere. But this convenience is built on sophisticated security protocols, real-time data processing, and massive infrastructure. Every time you check your balance, transfer funds, or withdraw cash, you are interacting with layers of technology and established rules that ensure the smooth, uninterrupted flow of your financial life. It's a testament to the quiet efficiency of the system, a system so robust that we rarely pause to think about how effortlessly it functions. These everyday mechanisms, digital transfers, credit card operations, interest rates, inflation, and the seamless access to our funds are the invisible gears of the financial machine. They work in the background, shaping our financial habits, influencing our decisions, and silently dictating the terms of our economic participation. They are not merely tools, they are the very environment in which our money lives and breathes. By understanding these subtle forces, we begin to see that money isn't just a static object, but a dynamic, ever-moving river, and our relationship with it is shaped less by grand pronouncements and more by these quiet, persistent currents. This deeper awareness of how money truly works in our daily lives then naturally leads us to ask, who are the skilled hands guiding these currents, the players behind the curtain? We've journeyed from the origins of money to the subtle psychological forces that keep it spinning, and then to the quiet everyday mechanisms that define its movement. Now it's time to turn our gaze to the architects, the custodians, and the powerful entities that pull the levers and turn the gears of this intricate system. These are the players behind the curtain whose decisions, strategies, and influence shape the financial world in profound ways, often far removed from our daily observations. It's like moving from understanding the currents of a river to identifying the engineers who build and manage the dams upstream. At the very top, in many countries, sits the central bank. Think of it as the conductor of the orchestra, the ultimate authority on a nation's money supply. In the United States, this is the Federal Reserve. In Europe, the European Central Bank. Their primary role isn't to deal with individual citizens, but to manage the entire financial system. They decide how much new money enters the economy, they set the key interest rates that influence all other borrowing, and they oversee commercial banks. They are the ones who print physical currency and create digital reserves. When the economy is slowing down, they might try to make money cheaper and more abundant to encourage spending. When inflation rises, they might tighten the reins. Their decisions, though often technical and distant, send ripples through every corner of the economy, affecting your mortgage rate, your savings interest, and even the price of your groceries. They are the ultimate custodians of the shared story of money, ensuring its stability and guiding its flow. Then we have the commercial banks, the names you know, your local branch, your online banking app. These are the frontline players, the ones who directly interact with us. They take your deposits, they offer loans for homes, cars, and businesses, and they facilitate the payments you make every day. Remember how we discussed fractional reserve banking? Commercial banks are where that happens. When they lend money, they are not just handing out existing funds, they are, in essence, creating new digital money within the system. This ability to create credit is their most powerful function and their primary source of profit. They are the arteries and veins of the financial body, carrying money to where it's needed, but also acting as gatekeepers, deciding who gets access to this vital resource and on what terms. Beyond the banks, there are a host of other influential players. Investment banks, for instance, don't deal with everyday consumers. Instead, they work with large corporations and governments, helping them raise capital by issuing stocks and bonds or advising on mergers and acquisitions. They are the deal makers, the financial strategists operating in the high-stakes world of corporate finance, moving colossal sums of money to reshape industries. Their decisions can lead to the rise or fall of major companies, affecting jobs, innovation, and economic landscapes on a broad scale. It's a world of immense complexity, where information and timing are king, and where the movements of billions can be decided in a matter of moments. And let's not forget the financial markets themselves. The stock exchanges, bond markets, and currency exchanges. These aren't entities in the same way banks are, but they are vital arenas where wealth is traded, valued, and shifted. Here, investors, from large pension funds to individual traders, buy claims on companies, stocks, or loans to governments and corporations, bonds. The collective mood and actions of these millions of participants, driven by psychology and perceived value, create the constant ebb and flow of asset prices. These markets are like vast, interconnected sensors reacting to news, expectations, and emotions, providing a real-time pulse of economic confidence and risk.
There are also powerful institutional investors, pension funds, mutual funds, hedge funds, and sovereign wealth funds. These are massive pools of money, often managed on behalf of millions of individuals or entire nations. They are significant owners of companies, major lenders to governments, and influential players in financial markets. Their investment decisions, guided by long-term strategies and short-term opportunities, can move markets, shape corporate behavior, and allocate capital on a global scale. When a large pension fund decides to invest in a new technology sector, it can spur innovation and growth. But a decision to pull out of a region can leave economic ripples.
Finally, we cannot overlook the role of governments and regulators. While central banks manage monetary policy, governments set fiscal policy, taxing and spending, and create the legal framework that defines how financial institutions operate. Regulators, often government agencies, enforce these rules, aiming to ensure fairness, prevent fraud, and maintain stability. They act as the referees, trying to balance the efficiency of the market with the protection of consumers and the overall health of the economy. Their constant challenge is to adapt these rules to a rapidly evolving financial world, a task that often feels like chasing shadows in a dimly lit room. These players, from the central bankers setting interest rates to the individual commercial banks processing your payments, form a complex ecosystem. They are interdependent, each influencing and being influenced by the others. Their actions are not always visible to us, but their collective power shapes the very architecture of our financial reality. It's in this landscape that a new kind of power emerges, shaped by sophisticated strategies, the tools of persuasion. We've navigated the origins of money, explored the psychological undercurrents that sustain it, understood its everyday mechanisms, and identified the powerful players behind the curtain. Now we turn our attention to how these players and the system itself gently guide our actions through sophisticated, often invisible tools of persuasion. This isn't about coercion, it's about the art of arranging options, shaping perceptions, and making certain financial choices feel natural, even inevitable. It's like understanding not just who controls the river, but how they subtly steer its flow using barely visible channels and currents. One of the most pervasive tools is advertising and marketing. From the moment we wake up, our senses are bathed in messages designed to connect money with desire. It's not just about selling a product, it's about selling an idea. A luxury car isn't just transportation, it's freedom, status, a reward for hard work. A particular investment isn't just about returns, it's about a secure future, peace of mind, the ability to retire comfortably. These messages expertly tap into the psychological drivers we discussed: security, status, freedom, instant gratification. They create narratives around money, associating it with happiness, success, and belonging. This constant stream of curated information shapes our wants, directing our spending, and subtly influencing how we perceive our own financial needs. It's a masterful performance, played out daily across every screen and billboard, often without us consciously registering its profound impact. Then, there are the defaults and nudges embedded in financial products. Think about signing up for a new bank account. Often, there's a default option for how your money is managed, or certain features are pre-selected. When you enroll in a retirement plan at work, you might be automatically opted in with the choice to opt out. These seemingly minor choices are powerful. Research consistently shows that people are far more likely to stick with the default option than to actively change it. It requires less effort, less thought. The financial industry uses this understanding to gently steer us towards certain behaviors, whether it's contributing to a 401k, choosing a particular insurance plan, or even how we manage our online banking settings. These nudges are rarely about forcing, they're about making the preferred path the easiest path, the path of least resistance. Consider also the framing of financial choices. How information is presented can dramatically alter our decisions. A loan offered as just pennies a day sounds far less daunting than an annual interest rate of 18%. Investment options presented with colorful charts showing past growth can feel more appealing than a stark warning about potential losses. Financial news often frames economic events in ways that can evoke fear or excitement, influencing market behavior. The language used, the visuals chosen, the stories told, all serve as persuasive tools, guiding our interpretation of risk and reward, scarcity and abundance. It's like looking through different colored lenses. The world remains the same, but our perception of it shifts dramatically. Another subtle but potent tool is the social proof and peer pressure woven into our financial lives. When everyone around us seems to be buying a particular type of home, investing in a trending stock, or acquiring the latest gadget, a powerful unconscious urge to conform can arise. We see others making these choices, and it creates a sense that these are the right or successful decisions. This isn't direct pressure, it's the quiet influence of observing collective behavior. Think of popular trends in investing, or the societal expectation to own certain assets by a certain age. These unspoken norms, amplified by social media, become powerful drivers, often leading us to make financial decisions that align with what appears to be the prevailing wisdom, even if it might not be the best choice for our individual circumstances. The design of financial products themselves is also a sophisticated tool of persuasion. Credit cards offer attractive rewards programs, enticing us to spend more to earn points. Buy now, pay later schemes promise immediate ownership with deferred pain. Savings accounts offer tempting introductory rates. These features aren't just practical, they are psychological hooks designed to make engaging with financial products more appealing, to encourage particular behaviors, spending, borrowing, even saving in specific ways. They create a sense of benefit, of advantage, making us feel smart for using them as they draw us deeper into the financial ecosystem. It's a carefully crafted dance where every feature, every incentive is a calculated invitation to participate. Even the very concept of financial literacy can be used as a persuasive tool. While genuinely empowering, the sheer volume of information and the complexity of financial products can sometimes overwhelm. This can lead to a feeling of inadequacy, making us more susceptible to advice from experts or to simply follow the easiest path presented to us. The system, in its vastness, can feel so impenetrable that we defer our judgment, relying on the persuasive narratives provided by those who understand its inner workings.
These tools of persuasion, advertising, defaults, framing, social proof, and product design are not always sinister. They are simply highly effective ways of guiding human behavior, built upon a deep understanding of our psychological makeup. They create the invisible channels through which the financial river flows, shaping our consumption, investment, and debt decisions in ways we rarely fully comprehend. By recognizing these subtle influences, we begin to regain a sense of agency, seeing the currents for what they are, and preparing ourselves to understand the deeper, more emotional architecture of power that these tools ultimately serve. Thank you for the encouragement. I'm glad to hear the generation is aligning with your vision.
We've peeled back layers of understanding, from money's humble beginnings to the sophisticated tools that subtly guide our financial choices. Now we arrive at a deeper, more profound level, the emotional architecture of power. This isn't about brute force or overt control. It's about how the financial system, and those who benefit most from its current design, tap into our most fundamental human emotions: fear, hope, anxiety, desire, to maintain stability and influence on a grand scale. It's like feeling the subtle vibrations of a massive bridge, recognizing its immense strength comes not just from steel and concrete, but from the invisible forces of tension and compression, carefully engineered to withstand the weight it carries. At its core, much of the system's power rests on fear. The fear of not having enough, the fear of financial ruin, the dread of not being able to provide for one's family. This fear, while deeply personal, is also a powerful collective motivator. It encourages saving, responsible spending, sometimes, and consistent participation in the workforce. It pushes us to borrow for education to secure a better future, or to invest to outpace inflation. When this fear becomes widespread, it can lead to economic contraction as people pull back on spending. When it's managed, it acts as a silent engine, keeping individuals striving, producing, and engaging with the system that promises to alleviate those very anxieties. Conversely, there is the powerful draw of hope and aspiration. This is the bright, shimmering counterpart to fear. It's the hope for a better life, for comfort, for advancement, for the ability to pursue dreams. Money, through its promise of choice and opportunity, becomes the tangible symbol of this hope. We hope to earn enough to buy a home, to send our children to college, to travel, to retire peacefully. This hope motivates entrepreneurship, innovation, and hard work. It fuels consumption as we purchase goods and services that represent our aspirations. The emotional power of advertising, which we discussed earlier, masterfully blends fear of missing out, of not being good enough, with hope of achieving status, happiness, and belonging through acquisition. It's a delicate balance where the system provides just enough hope to keep us engaged, even as it subtly reinforces the underlying anxieties. Consider the role of trust and its occasional betrayal. The entire financial system, at its most fundamental level, is built on trust. We trust that the money in our bank account is real, that our investments are being managed responsibly, that the government will uphold the value of its currency. This trust is not always earned by perfect performance, but often by habit, by the sheer continuity of the system. However, when trust is broken during financial crises, scandals, or periods of extreme instability, the emotional architecture of power cracks. Fear can quickly overwhelm hope, leading to widespread panic, bank runs, or market crashes. The players behind the curtain work tirelessly to maintain this trust, because they understand that without it, the entire edifice of fiat money and fractional reserve banking could crumble. The quiet anxiety about future stability, even if unarticulated, underpins much of our deference to financial authority. The system also skillfully harnesses desire, not just for material goods, but for experiences, for comfort, for ease. Credit offers instant fulfillment of these desires, bypassing the friction of saving. The promise of wealth taps into a primal desire for abundance and security. Financial innovation, in turn, continually creates new ways to fulfill these desires, from easy payment plans to sophisticated investment vehicles. This constant catering to desire keeps the wheels of consumption turning, ensuring a steady demand for products and services,
which in turn fuels economic activity and the need for more money. It's a self-perpetuating cycle, where desire drives consumption, consumption drives production, and production drives the need for financial mechanisms. Even something as abstract as economic data plays into this emotional architecture. When reports come out about GDP growth, unemployment rates, or inflation, they are not just numbers, they are narratives that evoke emotions. Good news can foster optimism, encouraging investment and spending. Bad news can trigger pessimism, leading to caution and retrenchment. The way these stories are framed by media and interpreted by experts can amplify these emotional responses, creating a collective mood that sways markets and influences public confidence. The perception of stability or instability, of growth or decline, is deeply emotional, guiding our collective financial pulse. The emotional architecture of power is not a conspiracy. It is a deeply ingrained reality of how human beings interact with a system that has become indispensable. It leverages our most basic feelings to create a stable, constantly moving financial world. Fear keeps us working. Hope keeps us striving. Trust maintains stability. Desire fuels consumption. These emotional forces are not just side effects, they are integral components of the design, ensuring our continued participation, our continued belief in the shared story of money. By understanding these emotional underpinnings, we begin to see the profound human dimension of the economic game itself. We've explored how money began, how our psychology fuels its engines, the unseen mechanics of its daily flow, who the powerful players are, and how they subtly persuade us by tapping into our deepest emotions. Now, let's bring all these threads together to understand the grand stage upon which it all plays out, the economic game. This isn't a board game with simple rules. It's a living, breathing, constantly shifting reality where every individual, every business, and every nation is a participant, guided by incentives, constraints, and the constant pursuit of advantage. Understanding this game isn't about winning or losing in a simplistic sense, but about discerning the deeper dynamics that shape prosperity, inequality, and the very structure of our global society. Imagine the economic world as a vast, interconnected ecosystem, much like a forest. Each tree is a business, each animal an individual consumer, the soil is the resource base, and the sun and rain on the flow of money and information. Just as in a forest, there are cycles, periods of growth and abundance, and times of scarcity or adjustment. These are known as economic cycles, the booms and busts, the expansions and contractions that define our financial landscape. During an expansion, businesses grow, jobs are plentiful, and money feels abundant. People spend more, borrow more, and confidence is high. But this can't last forever. Eventually, things slow down, sometimes gently, sometimes dramatically, leading to a contraction or recession. This is a natural rhythm, but one that is managed or mismanaged by the players behind the curtain, particularly central banks, who try to smooth out the extremes through interest rates and money supply. At the heart of this game is competition. Businesses compete for customers, workers compete for jobs, and nations compete for markets and resources. This competition is often seen as a driver of efficiency and innovation, pushing companies to create better products and services at lower prices. It's a relentless force, constantly reshaping industries and rewarding those who can adapt fastest. It's like a continuous race where the rules are always evolving, and the fastest, most adaptable participants often gain the most ground. A fundamental concept in this game is supply and demand.
This simple idea, often overlooked in its daily impact, dictates prices and influences production. If many people want something, high demand, but there's not much of it available, low supply, the price tends to go up. If there's too much of something, high supply, and not many buyers, low demand, the price falls. This invisible hand constantly adjusts the value of everything, from the cost of a cup of coffee to the price of a barrel of oil. It's a dynamic balancing act that guides resource allocation, telling businesses what to produce and how much, and informing consumers about the relative scarcity of goods. It is the silent arbitrator of value in the marketplace. Then there's the ongoing tension between individual freedom and collective responsibility. The economic game thrives on individual initiative, entrepreneurship, and the freedom to pursue profit. This pursuit, ideally, benefits society as a whole through innovation and wealth creation. However, unchecked individual pursuit can lead to inequalities, exploitation, and environmental damage. This is where governments and regulators step in, trying to set rules, impose taxes, and provide social safety nets to balance the scales. It's a constant negotiation, a perpetual search for the sweet spot where personal ambition can flourish without undermining the well-being of the wider community. The debate over how much intervention is just right is a central, enduring feature of the economic game.
Another critical aspect is the global nature of the game. International trade and finance mean that what happens in one part of the world can have profound effects everywhere else. A financial crisis in one country can trigger a domino effect across continents. Changes in currency values can make exports cheaper or more expensive. Supply chain disruptions can affect prices and availability worldwide. It's a truly interconnected web where economic decisions in Tokyo can ripple through London and impact a small business in Ohio. This global dance adds layers of complexity, making the game even harder to predict and control, and often making individual nations feel like smaller players on a much larger board. The economic game is also profoundly influenced by innovation and technology. New inventions, from the steam engine to the internet, completely reshape industries, create new forms of wealth, and destroy old ones. Technology automates tasks, increases efficiency, and changes how we work, shop, and live. The digital transformation, in particular, has accelerated this process, creating entirely new markets and challenging traditional economic models. It's a creative destruction, constantly tearing down the old to build the new, and in doing so, it continually alters the rules and players of the economic game. Ultimately, the economic game is a complex dance of incentives, human behavior, and systemic forces. It's a game where the pursuit of money, whether for security, status, or freedom, drives individuals and nations. It shapes our societies, allocates resources, and determines the distribution of wealth. By understanding its cycles, its core principles like supply and demand, its global interconnectedness, and the constant push and pull between various players, we gain a clearer perspective on the forces that shape our world. This intricate game, however, is undergoing its most profound transformation yet, driven by the very technologies that are reshaping every aspect of our lives, the digital transformation. We've journeyed through the timeless foundations of money, understanding its psychological grip and the grand economic game. Now we arrive at a seismic shift, a revolution that is profoundly reshaping every facet of this ancient system,
the digital transformation. This isn't just about faster transactions or online banking. It's about a fundamental re-architecture of how money is created, stored, transferred, and perceived. It's like moving from sailing ships to jet engines. The underlying principles of travel remain, but the speed, reach, and power are utterly transformed, creating both immense opportunities and unforeseen challenges. For most of history, money involved tangible items: shells, coins, banknotes. Even early banking relied on ledgers filled with pen and ink. But with the advent of computers and the internet, money began its quiet migration into the digital realm. What started as simple electronic transfers between banks has blossomed into a ubiquitous, often invisible flow of data. Every time you tap your card, make an online purchase, or check your bank balance on your phone, you are interacting with this vast, unseen digital infrastructure. This immediate, borderless movement of value has collapsed distances and accelerated the pace of economic life beyond anything our ancestors could have imagined. It's like turning on a light switch and having instant illumination instead of needing to light candles one by one. One of the most profound aspects of this transformation is the rise of digital currencies and cryptocurrencies. For centuries, central banks and governments held a near monopoly on issuing money. Now, with technologies like blockchain, private entities and even anonymous communities can create their own forms of digital value. Bitcoin, for example, emerged as a completely decentralized digital currency, independent of any government or bank. It introduced the idea that money could be verified and transferred securely without relying on a central authority. This concept is revolutionary because it challenges the very foundation of trust that traditional fiat money is built on. It promises greater transparency and less control by powerful institutions. But what happens when money isn't backed by a nation and its value fluctuates wildly with collective sentiment?
This digital frontier also includes central bank digital currencies, CBDCs. Recognizing the power and potential of digital money, many governments are now exploring or developing their own digital versions of their national currencies. Unlike cryptocurrencies, CBDCs would still be issued and controlled by central banks, maintaining that familiar oversight. The idea is to combine the efficiency and innovation of digital money with the stability and trust of government-backed currency. Imagine a digital dollar or a digital euro that could be used for instant payments, potentially bypassing commercial banks and credit card networks. This could fundamentally alter banking as we know it, offering new ways to deliver financial services and implement economic policy. It's a powerful experiment, poised to redefine the relationship between citizens, money, and the state. The digital transformation has also birthed entirely new forms of financial services, often called fintech. These are companies using technology to offer innovative solutions to traditional banking problems. Mobile payment apps allow you to send money instantly to friends. Robo-advisors use algorithms to manage your investments. Peer-to-peer lending platforms connect borrowers directly with lenders, bypassing traditional banks. These innovations are making financial services more accessible, more efficient, and often cheaper, especially for those in underserved communities. They are democratizing access to financial tools that were once exclusive to traditional institutions. It's like suddenly having a multitude of new paths and bridges opening up across the financial landscape, making it easier for more people to travel. However, this digital shift comes with its own set of challenges and complexities. Cybersecurity becomes paramount. As more of our wealth exists as digital data, the risk of theft, fraud, and system outages grows exponentially. Protecting these vast networks from malicious actors is a constant, escalating battle, requiring immense resources and vigilance. A breach of trust in the digital realm can have catastrophic financial consequences, far beyond the loss of a physical wallet. Furthermore, the digital transformation amplifies questions about privacy and data. Every digital transaction leaves a trail, a data point that can be collected, analyzed, and used. While this data can offer valuable insights and improve services, it also raises concerns about surveillance, algorithmic bias, and who ultimately controls our financial information. The ability to track every dollar, every transaction, creates a detailed picture of our lives, raising fundamental questions about the balance between convenience, security, and personal autonomy in a world where money is increasingly just information. The speed and global reach of digital money also introduce new regulatory complexities. How do you govern a decentralized cryptocurrency that operates across borders? Who is responsible when an online financial service fails? The old rules and boundaries designed for a physical world struggle to keep pace with the fluidity of the digital realm. This creates a constant tension between fostering innovation and ensuring stability and consumer protection. It's like trying to regulate a river whose course is constantly shifting and splitting into new, unpredictable streams. Ultimately, the digital transformation is not merely a technological upgrade, it is a profound societal evolution. It is democratizing access to financial tools for some, while raising new barriers and surveillance concerns for others. It is challenging the traditional power structures of banking and government, and forcing us to reconsider what money truly means. As money becomes increasingly ethereal, a string of bits and bytes, our relationship with it becomes even more abstract, more reliant on the unseen infrastructure and the new rules being written. This shift, while promising incredible efficiency and new possibilities, also demands a deeper awareness of its implications, particularly when we consider its silent, often overlooked human cost. We've explored the intricate tapestry of money's journey, from its historical roots and psychological grip to the hidden gears of its daily operation, the powerful players, the subtle tools of persuasion, and the sweeping digital revolution. Now, it's time to turn our gaze to the profound and often invisible consequences of this elaborate system on individuals, families, and communities. Beneath the hum of efficiency and the gleam of innovation, there is a human cost, a quiet toll exacted by a system designed for growth, competition, and perpetual motion. This isn't about numbers on a spreadsheet. It's about lived experience, the silent struggles, and the erosion of well-being that can occur when the human element is overshadowed by the pursuit of financial logic. One of the most visible human costs is the burden of debt. For many, debt isn't a strategic financial tool, it's a crushing weight, a constant whisper of obligation that can permeate every aspect of life. Student loans can stretch for decades, delaying major life decisions like marriage, home ownership, or starting a family. Credit card debt can be accumulated through everyday needs, or the pursuit of fleeting desires can spiral out of control, trapping individuals in a cycle of minimum payments and mounting interest. This isn't just a financial problem, it's a mental and emotional one. The stress of debt can lead to anxiety, depression, sleepless nights, and strained relationships. It limits choices, stifles dreams, and forces people to make difficult compromises between immediate needs and future aspirations. It's like living under a perpetual cloud where the sunlight of opportunity struggles to break through. The relentless pace and demands of the economic game also extract a significant toll on our time and well-being. In a system that often equates self-worth with net worth, there's an intense pressure to constantly work, to earn, to produce. For many, this means long hours, sacrificing personal time, family moments, and even sleep. The boundary between work and personal life blurs, especially in the digital age where work can intrude at any hour. This constant striving can lead to burnout, chronic stress, and a pervasive feeling of always chasing something just out of reach. We become caught in a treadmill where the promised rewards of money, security, freedom seem to necessitate an endless expenditure of the very things they promise to buy: time and peace. The quiet moments of reflection, the joy of simple leisure, can be squeezed out by the urgent demands of earning. Then there's the painful reality of inequality. While the economic system creates immense wealth, it often distributes it unevenly. Some benefit disproportionately from its mechanisms, accumulating vast fortunes, while others struggle to make ends meet despite working multiple jobs. This growing gap isn't just about different income levels, it's about vastly different life chances. It manifests in disparities in education, healthcare, housing, and access to opportunities. Children born into poverty often face an uphill battle from the start, regardless of their talent or effort. This creates a sense of unfairness, eroding social cohesion and trust. It's like a game where some players start with all the best pieces and an intimate knowledge of the rules, while others are handed broken pieces and no instruction manual. The digital transformation, while offering many conveniences, also brings its own unique human costs. The constant connectivity and the blurring of financial boundaries can lead to digital fatigue and addiction. The endless stream of information about investments, spending opportunities, and the financial successes of others can create a constant hum of comparison and inadequacy. For some, the ease of online gambling or rapid trading can spiral into destructive behaviors. The always-on nature of digital finance can erase the quiet spaces that allow for reflection and contentment. Furthermore, the rise of automation, a byproduct of digital efficiency, means that certain jobs disappear, leaving individuals facing unemployment, the need for retraining, and the emotional distress of displacement. It's a bittersweet progress, where efficiency for some can mean redundancy for others.
Beyond individual struggles, there's the cost to community and connection. In a highly monetized society, many essential human interactions and services, once based on mutual aid or shared values, become transactional. Care for the elderly, childcare, even companionship can be commodified. While efficiency is gained, something intangible is often lost: the warmth of neighborly support, the strength of reciprocal bonds. The relentless pursuit of individual financial gain can sometimes overshadow collective well-being, eroding the very fabric of community that provides a deeper kind of security and belonging than money alone ever could. The invisible threads of connection can fray when every interaction is weighed on a financial scale. Consider also the psychological impact of financial insecurity. Even for those not in dire poverty, the constant threat of economic instability, a potential layoff, an unexpected medical bill, a market downturn, can be a source of chronic, low-level stress. This insecurity can lead to conservative choices, stifling entrepreneurship and risk-taking. It can make people cling to jobs they dislike, afraid to pursue paths that might offer more fulfillment but less certainty. This pervasive underlying anxiety shapes our decisions, often guiding us towards safe, predictable paths, rather than those that might lead to greater personal growth or societal innovation. It's like walking on thin ice, always aware of the possibility of falling through. The human cost extends to a profound sense of disempowerment. When the financial system feels too vast, too complex, and too controlled by distant players, individuals can feel like cogs in a machine, with little agency over their own economic destiny. This feeling can breed cynicism, apathy, and a withdrawal from broader civic participation. It's a quiet resignation to a system perceived as unchangeable, leading to a loss of belief in the possibility of collective action or individual influence. When the rules of the economic game seem rigged or too obscure to understand, the desire to even play fairly can diminish. Finally, there is the environmental cost, which, though seemingly separate, is deeply intertwined with the human cost. A system built on perpetual growth and consumption, constantly incentivized by money, places immense strain on the planet's finite resources. The drive for profit can lead to decisions that prioritize short-term financial gain over long-term ecological health, ultimately impacting all of humanity. While not a direct human emotional toll, the awareness of environmental degradation and climate change contributes to a collective anxiety about the future, a deep, pervasive worry about the sustainability of the very economic model that provides our current comforts. It's a silent, accumulating debt that future generations will have to pay. The human cost of our financial system is not always loud or immediately obvious. It manifests in quiet anxieties, in unspoken limitations, in the subtle erosion of well-being, time, and connection. It highlights that money, while a powerful tool for good, is not neutral. Its design and its operation have profound, often unintended consequences on the quality of human life. Recognizing this cost is not about condemning the system entirely, but about gaining a more complete, more compassionate understanding of its true impact. Only with this awareness can we begin to consider if there is another way, if there is an illusion of choice preventing us from seeing paths to a more human-centered future.
We have journeyed through the intricate landscape of money, from its earliest forms to its digital frontiers, examining its psychological grip and its quiet human cost. Now we arrive at a particularly subtle and pervasive aspect of the modern financial system, the illusion of choice. On the surface, our world appears to offer an endless array of options. Countless brands, diverse investments, myriad pathways to earn and spend. We are presented with a kaleidoscope of financial products, a vast supermarket of services, each promising to cater to our unique needs and desires. But beneath this shimmering surface of apparent freedom lies a carefully constructed reality, where our decisions are often guided, constrained, and subtly predetermined in ways we rarely perceive. It's like standing in a maze with many paths, only to realize that all paths, however circuitous, eventually lead to a handful of predetermined exits. Consider the act of choosing a bank. You might weigh options. One offers a slightly better interest rate on savings, another has more convenient ATM locations, a third advertises a compelling credit card reward program. This feels like genuine choice, a personal decision based on individual preferences. Yet behind the scenes, the vast majority of banks operate within very similar regulatory frameworks, offer largely standardized products, and are often owned or controlled by a relatively small number of colossal financial institutions. The differences, while marketed as significant, can often be superficial. Different branding, slightly varied fee structures, but fundamentally the same core services delivered within the same systemic constraints. The illusion is in the perceived diversity, masking a deeper uniformity, where competition often focuses on marginal differentiators rather than fundamentally different ways of operating. This phenomenon extends to consumer goods and services. We believe we are free to choose from an abundance of products reflecting our individual tastes and values. Take, for instance, the sheer number of brands in a grocery store aisle. Yet a closer look often reveals that these diverse brands are frequently owned by a handful of massive parent companies. The choice is not between genuinely distinct corporate philosophies or production methods, but between different marketing narratives crafted by the same underlying entity. This consolidation of ownership creates a powerful, centralized influence over supply chains, pricing, and messaging, subtly shaping our collective consumption patterns while maintaining the facade of boundless variety. Our choices become confined within a pre-approved menu, even if the menu itself appears vast. The illusion is particularly potent in the realm of career and livelihood. We are told we have the freedom to choose any profession, to pursue our passions, to climb the ladder of success. And certainly, individual effort and talent play a role. However, the economic system itself, driven by its need for perpetual growth and efficiency, creates specific demands for labor. Certain skills become highly valued, others devalued. Educational institutions, often funded and influenced by industry needs, train us for roles that fit within the existing economic framework. The pressure to earn enough to manage debt, afford housing, and maintain a desired lifestyle can subtly steer us away from less financially lucrative passions and towards more secure or high-paying jobs, even if they offer less personal fulfillment. Our choice of career is often implicitly shaped by the economic imperatives of the system, rather than solely by genuine personal inclination. It's like picking a path from a map, but the map itself was drawn to favor certain destinations. Even our decisions about saving and investing are subject to this illusion. We are presented with a multitude of investment vehicles: stocks, bonds, mutual funds, real estate, cryptocurrencies. Each comes with its own promises and risks, and we believe we are making informed choices. Yet, the entire investment landscape is deeply influenced by the same central bank policies, the same market trends, and the same algorithms that analyze and predict our behavior. The information we receive is often filtered through financial advisors who are compensated by specific products, or through media outlets that sensationalize certain trends. Our choices, though seemingly independent, are influenced by a collective narrative of what constitutes a good or safe investment, a narrative often crafted by the very institutions that profit from our participation. The illusion here is that we are navigating a free and open sea, when in reality we are sailing within carefully marked channels with powerful currents beneath. The digital transformation, while offering new avenues for expression and connection, also paradoxically strengthens the illusion of choice. The Internet presents us with an unprecedented amount of information and options, yet algorithms, driven by profit and engagement metrics, increasingly filter what we see. News feeds, shopping recommendations, and even social connections are curated based on our past behavior, creating filter bubbles and echo chambers. This means that while the total amount of information is vast, the specific information we are exposed to becomes increasingly narrow and personalized, subtly reinforcing existing biases and limiting our exposure to genuinely alternative viewpoints. Our choices of what to consume, read, or believe are often guided by these unseen digital gatekeepers, making the world appear diverse while narrowing our actual experience of it. Furthermore, the very concept of financial literacy, while critical, can inadvertently contribute to the illusion. We are encouraged to learn about budgets, investments, and economic principles, empowering us to make smart choices. But this emphasis often places the burden solely on the individual, implying that if one simply makes the right choices, financial success is guaranteed. This perspective can obscure the systemic factors, the structural inequalities, the inherent biases of the market, the overwhelming power of the financial players that often limit even the most well-informed individual. It fosters the belief that economic outcomes are purely a result of personal choice, rather than a complex interplay between individual agency and systemic design. It implies that if you just follow the map correctly, you'll reach your destination, even if the map itself contains hidden traps or leads only to a few predetermined points. The illusion of choice is not a malicious plot, but a natural outcome of a system built for efficiency, growth, and the smooth flow of capital. It's a consequence of consolidation, sophisticated marketing, and the inherent human tendency to follow the path of least resistance. It means that while we feel we are making sovereign decisions, our actions are often subtly channeled into directions that ultimately serve the broader system. Recognizing this illusion is not about despair, it's about gaining a more profound awareness. It's about understanding that true freedom may not lie in the number of options presented, but in the ability to critically examine the framework within which those options exist. And this awareness, in turn, is the first vital step towards breaking the cycle and seeing clearly. We've journeyed through the intricate design of money, from its ancient origins to its digital present, exploring its psychological currents, its everyday mechanics, the powerful players, the subtle tools of persuasion, the quiet human cost, and the pervasive illusion of choice. Now we arrive at a pivotal moment, breaking the cycle and seeing clearly. This isn't a call for revolution, nor is it a simple list of financial tips. It's an invitation to a deeper form of liberation, the freedom that comes from understanding, from seeing the hidden patterns, and from choosing a more conscious path within a system that often operates on unconscious participation. It's like stepping out of a gently flowing river to stand on the bank, observing the currents, the eddies, and the subtle forces that once carried you along, allowing you to choose your next step with intention rather than simply being swept downstream. The first step in breaking the cycle is simply awareness. This entire journey has been about pulling back the curtain, illuminating the invisible, recognizing that money is more than just numbers. It's a story, a shared belief system, a powerful design built upon human psychology and intricate mechanisms. Understanding that debt is not just a personal failing, but an integral part of how money is created and circulated. Seeing that your choices, while feeling free, are often subtly guided by powerful players and persuasive tools. This awareness, like a gentle dawn, sheds light on the shadows, allowing us to see the system for what it truly is, rather than just what it appears to be. It's a shift from being a passive participant to an informed observer, capable of making more deliberate decisions. A crucial aspect of breaking the cycle involves redefining our relationship with consumption. The economic game thrives on perpetual demand, constantly whispering that happiness lies in acquiring more. Seeing clearly means recognizing that this is often an illusion, a powerful persuasive tool. It means distinguishing between genuine needs and externally generated desires. It might involve embracing intentional spending, prioritizing experiences over possessions, or investing in durability rather than fleeting trends. This isn't about deprivation, but about liberation,
freeing ourselves from the treadmill of constant acquisition and reclaiming agency over our desires. It's about finding contentment not in the latest product, but in alignment with our true values, thereby reducing our susceptibility to the constant emotional triggers of advertising. It's a quiet rebellion against the relentless push to buy, buy, buy. This also extends to our relationship with debt. Understanding debt not just as a personal responsibility, but as a systemic tool. While some debt can be a strategic lever for growth, like a mortgage leading to homeownership, other forms can be shackles. Breaking the cycle involves conscious choices around borrowing, scrutinizing interest rates, understanding repayment terms, and questioning whether the instant gratification offered by credit truly outweighs the long-term obligation. It's about being mindful of the subtle psychological lures of credit and making deliberate choices to avoid or minimize the forms of debt that erode our freedom and peace of mind. Furthermore, breaking the cycle involves actively seeking diversification, not just in investments, but in our sources of security. In a world where jobs can be automated and industries can vanish, relying solely on a single income stream or a single employer can be precarious. Seeing clearly means building resilience, developing multiple skills, cultivating diverse networks, and exploring alternative income streams. It's about not putting all your eggs in one basket, not just financially, but in terms of your capabilities and connections. This creates a broader base of security, reducing vulnerability to the whims of the economic cycle and the decisions of distant players. It's about building multiple rafts, so you're never fully dependent on a single ship. Crucially, seeing clearly also means understanding and nurturing community and connection as forms of wealth. In a highly monetized world, we often forget that some of the most valuable resources are non-monetary. Supportive relationships, shared knowledge, mutual aid, and a sense of belonging. Actively investing time and energy in these aspects of life, volunteering, participating in local groups, supporting small businesses, engaging in skill sharing can create a different kind of safety net, a different kind of abundance. It's remembering that true prosperity is not just about what we accumulate, but about what we share and what we build together. The digital transformation offers both challenges and opportunities for breaking the cycle. Seeing clearly means becoming discerning digital citizens. It involves actively managing our digital footprint, understanding privacy settings, critically evaluating online information, and recognizing algorithmic influences. It means harnessing the power of technology for our benefit, rather than allowing it to subtly control our attention and choices. It's about becoming the shepherd of our digital experience, rather than a sheep in the digital flock. Finally, breaking the cycle and seeing clearly involves a profound shift towards intentionality and agency. It's about recognizing that while the system is vast and powerful, we are not helpless cogs. Every conscious choice we make, about how we earn, save, spend, and invest, about how we consume information, about where we place our energy and trust, sends a ripple. These individual ripples, when multiplied by many, have the power to subtly shift the collective currents. It's about reclaiming our power as informed participants, making choices that align with our deepest values, rather than simply conforming to the system's design. This journey of seeing clearly is not about achieving a perfect financial state, but about cultivating a more aware, more deliberate, and ultimately a more liberated relationship with money. It's about realizing that you can't unsee what you now understand, and this understanding itself is a profound form of freedom.
leading us to our final reflection on what true awareness feels like. We began this journey by acknowledging an invisible influence, a quiet power shaping our lives. Now, as the journey concludes, what does true awareness feel like? It's not a sudden burst of revelation, but a gentle, unfolding clarity, much like seeing the distinct patterns woven into a tapestry you once viewed as a blur. You now understand that money is not just a neutral tool, but a living system, a shared story built on centuries of evolution, intricate mechanisms, and profound psychological undercurrents. You've seen the powerful players, the subtle tools of persuasion, and the quiet human costs that ripple through lives and communities. You've glimpsed the illusion of choice, recognizing that beneath a veneer of endless options, certain paths are subtly yet powerfully encouraged. True awareness isn't about solving every problem or dismantling the system overnight. It's about reclaiming your inner landscape. It's the peace that comes from recognizing the currents, rather than being unknowingly swept along. It's the quiet strength found in discerning the whispers of persuasion from the voice of your own values. You now see the threads of the financial web, not as an oppressive cage, but as an interconnected design, a reality you can engage with more intentionally. You can't unsee what you now understand. This new clarity empowers you, not with answers to every financial question, but with a foundational wisdom. It offers a sense of calm, a deeper grounding in how the world quietly runs itself. With this awareness, you can choose your steps more deliberately, navigate the currents with greater discernment, and cultivate a relationship with money that is less about unconscious reaction and more about conscious alignment. This understanding, this quiet awareness, is a profound form of freedom, allowing you to move forward with a renewed sense of purpose and a deeper connection to the true rhythm of your life.